Welcome back, everybody, to the deep dive. This week, we're going to be looking ahead to the week of March 24th through the 30th, 2025, in the financial markets.
Right.
You've sent over a ton of information, like you always do, and what we want to do is kind of distill it down
Yeah.
into what are the key things that are going to be happening this week, and more importantly, what does it all mean, kind of building on what we saw in the week before,
Yeah.
March 17th through the 23rd.
Yeah. Think of this as your kind of personal briefing on the way ahead.
Yeah.
So we've gone through and picked out from all the data you've sent what we think are the most important things for you to be watching and thinking about as you get ready to navigate this coming week.
Awesome. Okay, so let's first recap the week that was just to kind of set the table here. It was kind of a mixed bag, right? You saw the Dow Jones leading the way up a pretty decent 1.2%. The S&P 500 also up, about 0.5%, and then the Nasdaq Composite just slightly positive territory, 0.2%. And one of the things that really stood out to me is that we saw a sell-off in AI-related stocks, and this was largely due to, I think, NVIDIA's GTC conference.
Yeah, I think what's really interesting here is that dynamic between this sort of excitement around AI and all the potential it has, but also this underlying worry about how much some of these AI companies are worth. NVIDIA had this conference, they showcased some really cool stuff, but I think it sort of prompted investors to maybe take some profits off the table.
Right.
And that had a knock-on effect on the Nasdaq and sort of broader tech. And then in contrast, you see the Dow, which is, much more traditional index doing really well. So it's sort of this interesting dynamic between these two different parts of the market.
Totally. And then, zooming out to kind of the macro picture that affects everybody. The latest U.S. inflation numbers for February showed a slight moderation to 2.8% year over year.
Okay.
That's down from 3% in January, which is encouraging, but it's still above the Federal Reserve's target of 2%. And then as far as interest rates go, the major central banks, the Fed, the Bank of England, the Bank of Japan, they all decided to hold rates steady at their recent meetings.
Yeah, so I think what's important here is to connect this back to what it means for you. So while that little dip in U.S. inflation is definitely a good sign, the fact that it's still above the Fed's target means that they're probably going to stay pretty vigilant and keep a close eye on things.
Yeah.
And the central bank's decision to hold rates steady, I think, kind of reflects this balancing act they're trying to pull off. They want to cool inflation, but they don't want to send the economy into a tailspin. It's kind of a delicate situation. And also, keep in mind, inflation isn't just a U.S. story. Places like Japan and the U.K. are still grappling with pretty high inflation levels, so it's definitely a global issue.
Oh, and just to clarify, we saw slightly different numbers in the sources for the Fed's rate. One mentioned 4.25 to 4.5%, and another just said 4.5%.
Right.
But the takeaway for you is that they kept rates unchanged within that range.
Gotcha. Okay, and then switching gears a little bit to the kind of global events that can, really make waves in the markets and potentially affect, your investments. We had some interesting developments on the geopolitical front. Oil prices were all over the place, thanks to those ongoing ceasefire talks in Ukraine.
Right.
And gold had a huge surge. It broke past $3,000 an ounce before pulling back a little. Yeah, and these kinds of movements really show just how sensitive commodity markets can be to global uncertainty. When you have, these geopolitical tensions like what's happening in Ukraine, it can really create worries about supply disruptions, especially when it comes to things like energy, so they can push prices up. And then with gold, the fact that it jumped up like that really suggests that investors are looking for safer places to park their money when things are uncertain. And then the pullback that we saw afterwards, that could just be investors taking some profits or maybe a sign that the immediate concerns have eased a little bit.
Makes sense. And then last but not least, on our recap of the week, we had the announcement of new U.S. tariffs on imports from Canada and Mexico, and this, got a lot of people talking and raised some concerns about possible trade disruptions.
Yeah, and this is something that, you really want to keep an eye on, the potential impact of these tariffs on global trade and economic growth. I mean, any measures that restrict the flow of goods between countries can have all kinds of unintended consequences.
Yeah.
It can lead to higher prices for businesses and ultimately for consumers like you.
Right.
It's definitely a situation to watch.
Okay, so keeping all of that in mind from the past week, let's turn our attention to the week ahead, March 24th through the 30th. What are the key things that you should be paying attention to?
Well, I think this week, the earnings season is really going to heat up, particularly in the tech sector. So after that recent dip in AI-related stocks following NVIDIA's update, Investors are going to be laser focused on what other big tech companies have to say in their earnings calls. They're going to be looking for clues about their growth prospects and whether we might be seeing this broader shift that people are calling a sector rotation.
Yeah.
So that's sort of like investors deciding that maybe the high growth tech stocks have had their run and now it's time for some of the more stable sectors to take the lead. So specifically some companies to watch this week. KB Home is reporting on Monday, GameStop and McCormick are reporting on Tuesday, and then Lululemon is on Thursday. So, their results and what they say about the future could give you some really valuable insights into different parts of the economy.
And beyond just how individual companies are doing, we've also got some big economic data coming out of the U.S. that we should be watching, right?
Well, absolutely. So this week brings us the core PCE price index. So that's the personal consumption expenditures price index. And it's the Fed's preferred way of measuring inflation because it strips out those volatile food and energy prices and gives you a better sense of the underlying trend. So after the Fed's recent comments hinting that inflation might be a bit stickier than they thought, this data release is going to be super important. We'll also be getting the final reading for fourth quarter GDP, so that'll give us a definitive look at how the economy wrapped up last year. And then we've got durable goods orders for February, which tells you how much businesses are investing, and personal income data, which reflects the financial health of consumers. So all of these data points are going to give us a much clearer picture of the current economic momentum.
And it's not just U.S. data that we should be keeping an eye on. The U.K. is also scheduled to release its inflation figures this week.
Yeah, that's right. And the expectation is that the UK CPI data for February is going to confirm that inflation is remaining stubbornly high on the other side of the Atlantic. So this will be another piece of the puzzle in understanding that global inflation picture and the challenges that different central banks are facing.
Okay, so as far as central bank activity this week, it looks like most of the major players are expected to stay on the sidelines. But there is one notable decision on the calendar.
Yeah, you're right. Norway's central bank is going to announce its interest rate decision on March 27th. And given those ongoing inflationary pressures in Norway, the markets are pretty much expecting a rate hike. So it just goes to show that different economies are facing their own unique challenges and responding in their own ways.
Right.
And just so you know, we're not expecting any policy meetings from the Fed, the Bank of England, or the Bank of Japan this week.
Gotcha. And we can't forget about those geopolitical factors, which, as we've talked about, can always throw a wrench into things.
Yeah, for sure. You definitely want to keep monitoring the impact of those recently announced tariffs and any new developments in the Ukraine ceasefire negotiations. These events have the potential to really move commodity prices and also affect overall investor sentiment, which ultimately has an impact on your portfolio. And President Trump is scheduled to have a call with Russian President Putin regarding the Ukraine situation. And depending on how that conversation goes, it could definitely have an impact on market sentiment.
Absolutely. All right, so let's dive a little deeper now into some of these market trends that could be really relevant to you. We talked about the AI sector experiencing some valuation pressures lately, but it sounds like the long-term outlook is still pretty positive.
Yeah, I think the important thing to remember here is that while you might see some short-term volatility and maybe some concerns about whether valuations got a little ahead of themselves, the fundamental growth potential of AI is still incredibly strong. We're seeing it being adopted across so many different industries. So for long-term investors, it's still considered a very attractive area. And it's also interesting to note that while we saw that dip in those large cap AI stocks, you might actually see increased interest in some of the smaller, more specialized AI firms whose innovations maybe weren't as prominent at NVIDIA's conference. So that could be a potential opportunity for investors who are looking beyond those mega cap companies.
That's a good point. And it seems like in times of uncertainty, investors often flock to those kind of traditional safe haven assets.
Yeah, absolutely. Commodities like gold and silver are increasingly viewed as safe havens when there's a lot of geopolitical instability in the world. And the general expectation is that gold in particular will maintain its upward trajectory, with some analysts even saying that it could stay around that $3,000 an ounce level. Energy markets, on the other hand, are likely to remain pretty volatile, driven by those geopolitical risks we talked about and the potential for tariff-related disruptions to those global supply chains. So that's something to keep an eye on, especially if you're feeling it at the gas pump.
For sure. And then for those of you who like to keep an eye on some of the more technical aspects of the market, what are some of the indicators that you should be watching this week?
Well, the S&P Global Manufacturing PMI for March is going to be a key one. It gives you a really good snapshot of whether the global manufacturing sector is expanding or contracting. And that's a pretty reliable indicator of overall global economic health.
Mm.
In the US, while the stock market has been relatively resilient, it is facing some headwinds from those higher bond yields. The 10-year Treasury yield hovering around 4.3% is something to keep in mind, and also those concerns about government budget deficits, which could eventually start to weigh on corporate profitability.
Okay. And, it's always important to be aware of the potential downsides. What are some of the key risks and uncertainties that we're facing right now?
Well, those trade policy changes and tariffs that we talked about are definitely up there. They have the potential to really dampen global economic growth if they escalate further. And even though we've seen some moderation in inflation, there's still that lingering concern that it could remain elevated for longer than central banks would like. And then, of course, any further escalation of geopolitical tensions could throw another wrench into the works and potentially disrupt those commodity markets even further. So, we even heard from Jim Chalmers, who's Australia's treasurer, and he warned about a possible seismic economic shock coming from the U.S. due to policy uncertainties and potential trade disruptions. So it really highlights how interconnected these global risks are.
Right. It's interesting to think about how AI is having an impact not just on, the stock market and tech stocks, but also on the broader financial industry that, everybody interacts with on a daily basis.
Absolutely. Financial institutions are using AI for all sorts of things these days, from streamlining their operations to detecting fraud more effectively and even providing more personalized services to customers. But it's also important to note that security concerns are still a big hurdle to wider adoption of AI in some areas, especially those that involve sensitive data. And we're also seeing a growing trend of using what's called generative AI for things like predictive analytics and investment strategies. So that's opening up some really interesting opportunities for firms that are investing in those advanced technologies.
Okay, so what are the experts saying about their outlook for the economy for the rest of the year?
Well, JP Morgan, for instance, is forecasting global GDP growth at about 2.5% for 2025. But they also caution about the potential for a lot of volatility due to those policy uncertainties and geopolitical risks that we've been discussing. The American Bankers Association is a bit more specific about the U.S. They're expecting moderate economic growth at about 2.1% annually through 2026. But they also highlight those downside risks from tariffs that could potentially drag on growth.
And how about their thoughts on the stock market?
Well, interestingly, Wall Street analysts, on average, seem to be relatively optimistic. Their current projections suggest that the S&P 500 could gain as much as 10% this year. And this optimism is largely based on the expectation that inflation will continue to ease, and that those innovations in AI will help boost corporate earnings.
All right, so let's bring it all together now. What are some practical takeaways or things that you should be thinking about based on all of this information that we've covered?
Well, based on our discussion today, it might be wise to consider diversifying your portfolio into commodities like gold or silver as a way to potentially hedge against those ongoing geopolitical risks. Given the recent pullback in the AI sector, it's also worth keeping a close eye on those upcoming earnings reports from AI-focused companies. There might be some buying opportunities there, but as always, make sure you do your due diligence. And staying informed about those key inflation data releases, particularly that core PCE index, is going to be really important because it could have a big impact on what the Fed decides to do with interest rates and how the markets react. And finally, you might want to take a look at your exposure to international stocks and just be mindful of the fact that those tariffs could potentially have a negative impact on the performance of emerging markets.
Awesome. Some really great takeaways there. So to sum up, this coming week is shaping up to be a really important one. We've got some key economic data coming out, those crucial earnings reports that we talked about, and those ongoing geopolitical events that could really move the markets. So it just highlights how important it is to stay informed and be flexible and, be ready to adapt to those changing circumstances.
Yeah, absolutely. How all of these different factors interact is really going to be key to understanding where the markets are headed in the weeks and months ahead.
Totally. And with that in mind, here's a final thought for you to ponder as we wrap up. Given all of these mixed signals that we're seeing with inflation moderating in some areas, but those persistent global uncertainties and this incredible pace of advancement in AI, what do you see as the biggest opportunity or the biggest risk for the rest of 2025? How do all these different pieces of the puzzle fit together in your own understanding of the markets? It's definitely something to think about. Thanks for joining us for this deep dive this week.
Thanks for having me.
We'll see you next time.
See you next time.